There are three primary types of disability insurance policies: cancelable, guaranteed renewable, and non-cancelable. The type of policy an individual can get often depends on their occupation, as occupations with higher risk generally have less favorable policy options. Cancelable policy. A cancelable policy gives the insurance company the right to cancel the coverage at any time, typically on the policy's anniversary date. The insurance company may choose to cancel the policy if the insured's occupational classification no longer fits their mandate, if they are losing money on the risk, or if claims for that group are much higher than the premiums collected. This policy type is often the least expensive because the policyholder takes on some of the risk of the contract being canceled. Cancelable policies are usually offered to blue-collar workers or those in higher risk occupations, such as truck drivers, taxi drivers, and construction workers. Guaranteed renewable policy. A guaranteed renewable policy assures the policyholder that the insurance company cannot cancel the contract, regardless of whether they are losing money on the policy. The policy is guaranteed to renew, typically up to age 65, when disability insurance usually ceases. However, while the contract is guaranteed to renew, the premium is not guaranteed. The insurance company can increase premiums if they are losing money or the risk is too high. They can also make other adjustments, such as extending the waiting period or lowering benefits, to mitigate losses. This type of policy is considered a middle ground option and is often provided to white-collar workers and middle managers. Non-cancelable policy. A non-cancelable policy is the most comprehensive and expensive option. With this policy, the insurance company cannot cancel the contract, decrease benefits, or increase premiums. The insurance company assumes all the risk, as long as the policyholder continues to pay their premiums. This policy is typically for high-income professionals like lawyers, doctors, and executives, as it offers the highest level of protection. The likelihood of these professionals becoming disabled or staying off work for long periods is considered low. Other disability policy types. Guaranteed issue. This is a group policy where the insurer guarantees coverage to a group of people without individual underwriting. The insurer looks at the size of the group and its occupation to spread the risk. This type of policy often covers pre-existing conditions and is a fixed rate for everyone in the group. Guaranteed to issue. This policy type differs from guaranteed issue in that the insurer guarantees they will issue something to the group, but the specific terms and conditions are determined after preliminary underwriting. They may eliminate people with pre-existing conditions and will assess the risk of the group before setting the final premium and benefits. Disability riders. Riders are add-ons that customize a policy's coverage and cost. They enhance the basic policy. Future purchase option, FPO, also known as a future income option, FIO. This rider allows a policyholder to buy additional disability insurance in the future without providing medical evidence of insurability. The premium for the additional coverage is based on the policyholder's attained age at the time they exercise the option. This is particularly useful for young professionals with low starting incomes who expect their earnings to grow. The total benefit amount, including the additional coverage, must still adhere to the 60% rule, or sometimes 65%, of gross income. Cost of living adjustment. COLA. This rider adjusts the disability benefit to account for inflation and maintain the purchasing power of the payments. The adjustment can be calculated using a simple interest or compound interest method, often tied to the Consumer Price Index, CPI. Accidental death and dismemberment. AD&D. This rider provides a lump sum payment if the insured dies in an accident. It also pays a portion of the benefit if they lose a limb or body part, based on a table provided by the insurer. The death or dismemberment must occur within 365 days of the accident to be covered. Residual benefit. This rider is designed for high-net-worth individuals and professionals who may return to work part-time after a disability but still have a significant loss of income. The benefit is a percentage of the original monthly benefit, calculated based on the percentage of income lost. The formula is original earnings, earnings after disability, / original earnings. This rider typically applies when the percentage loss of income is between 20% and 80%. Partial disability. Similar to the residual benefit, this rider is typically for blue-collar workers. It pays a fixed percentage, usually 50%, of the benefit amount for total disability if the person can return to work part-time. Return of premium, ROP. This rider returns a portion or all of the premiums paid by the policyholder. The refund is tax-free. Common ROP types include a refund of a certain percentage, e.g., 75%, of premiums if no claims were made. A refund of the difference between premiums paid and claims received. A refund, e.g., 70 to 80%, if the policy is canceled after 8 to 10 years. Definitions of total disability. There are three main definitions of total disability that determine how benefits are paid. Any occupation. This is the most restrictive definition. Benefits are paid only if the individual is unable to perform any job for which they are reasonably suited by education, training, or experience. If the policyholder can return to work in any capacity and is gainfully employed, the benefits will stop. This is typically a feature of cancelable policies for blue-collar workers. Regular occupation. The insurance company encourages the insured to return to work, even if they cannot perform their regular job or work the same number of hours. The benefit payment is reduced dollar for dollar by the income earned from the new work. This definition is common in policies for middle management and white-collar workers. Own occupation. This is the most generous definition. The policy will continue to pay full benefits as long as the insured cannot perform the duties of their own specific occupation, even if they can work and earn an income in a different field. This is a standard feature of non-cancelable policies for high-end professionals. Other disability definitions. Presumptive disability. It is presumed that the individual will never recover from the disability. The policy will continue to pay benefits for the full benefit period regardless of whether the person returns to work and earns an income. This applies to catastrophic losses such as the loss of 2 limbs, eyesight, hearing, or speech. This is only available on individual private policies, not on group insurance plans. Canada Pension Plan, CPP. The CPP provides a disability benefit, but the definition of disability is very strict. The ailment must be both severe and prolonged, meaning it is expected to last a long time and prevents the person from doing any kind of work. The waiting period for CPP disability is 4 months, and the person must be under the care of a medical doctor, MD. Claim denials. An insurance company can deny a disability claim for 3 main reasons. Absence of loss. Disability insurance is an income replacement product. If a person is unemployed at the time of disability, there is no income to replace, and the claim will be denied. The policyholder must be actively and gainfully employed at the time of application and disability. Absence of proof. The insurance company requires proof of disability from a medical doctor. Reports from nurses or paramedics are not considered sufficient proof. Delay. A claim should be submitted within 30 days of the incident, and all necessary documentation should be provided within 90 days. While there may be mitigating circumstances for a delay, a claim submitted after a significant amount of time, e.g., a year, may be denied. Recurring disability. This is a provision that protects the policyholder if they return to work after a disability but the same or a related condition causes them to become disabled again within a specific time frame, typically 6 months. The key benefit of a recurring disability provision is that it waives the initial waiting period, so the policyholder doesn't have to wait to receive benefits again. If the disability recurs after 6 months, it's treated as a new claim, and the waiting period would apply again.